deep dive into the hidden history of central banking. In part 2, we will start in America. Now, this is a story of power, control, and relentless struggle. From the early days of colonial America to the establishment of the Federal Reserve, this saga is filled with intrigue, rebellion, and financial manipulation. Stay tuned as we uncover the century-long battle between the people and the powerful banking interests. In the 17th century, the American colonies began issuing their own paper money, known as colonial script. This innovation allowed them to control their finances independently from British banks, fostering economic growth and stability. Benjamin Franklin, visiting London in 1763, was shocked by the poverty he witnessed. He attributed the prosperity of American colonies to their ability to issue their own money. However, this freedom was short-lived. In 1764, the Bank of England imposed a currency bill that severely restricted the colonies' ability to issue their own money, leading to the economic collapse and setting the stage for the American Revolution. As America fought for its independence, the Second Continental Congress issued its own currency to finance the war effort, but the British countered with massive amounts of counterfeit currency, destabilizing the economy. After the war, the establishment of the Bank of North America marked the beginning of centralized banking in the United States. In 1791, Alexander Hamilton, the Secretary of Treasury, orchestrated the creation of the first Bank of the United States, modeled after the Bank of England. Despite fierce opposition from figures like Thomas Jefferson and James Madison, who warned of the dangers of a centralized banking power, the bank operated until its charter expired in 1811. The expiration of the first bank's charter led to economic turmoil. In 1816, the Second Bank of the United States was established, but this institution, too, was fraught with controversy and opposition. President Andrew Jackson, a staunch opponent of centralized banking, famously declared, "The monster must perish." His administration saw the dismantling of the Second Bank, ushering in a period without a central bank that lasted until the Civil War. During the Civil War, President Abraham Lincoln faced the challenge of financing the war effort. Rejecting high-interest loans from private bankers, Lincoln issued $347 million in greenbacks, debt-free currency that helped fund the Union's victory. However, Lincoln's defiance of powerful banking interests allegedly led to his assassination, a dark chapter in the struggle over financial control in America. The late 19th and early 20th centuries were marked by financial panics and economic instability, which proponents argued could only be solved by a central banking system. In 1910, a secretive meeting on Jekyll Island laid the groundwork for the Federal Reserve System. Influential bankers and politicians crafted a plan to establish a central bank that would control the nation's money supply. Despite significant opposition, the Federal Reserve Act was signed into law on December 23, 1913. Promoters promised stability and prosperity, but the reality has been a century of economic booms and busts, with the dollar losing 97% of its purchasing power since the Fed's inception. The Federal Reserve, a private entity controlled by powerful banking interests, has operated largely without public oversight. Its impact on the American economy and the global financial system remains profound and controversial. In the early 19th century, Europe was reeling from the chaos of the Napoleonic Wars. Leaders convened at the Congress of Vienna from September 1814 to June 1815 to reshape the continent. Behind closed doors, a powerful figure sought to transform global finance forever: Nathan Meyer Rothschild. Rothschild proposed a new world order centered around central banking. This system aimed to control national economies through a network of banks, all indebted to the Rothschilds. However, one leader stood firm against this scheme. Tsar Alexander I of Russia refused to succumb to the Rothschilds' plan. Instead, he formed the Holy Alliance with Austria and Prussia, rejecting the establishment of central bank in Russia. His decision sparked the ire of the Rothschilds, who would later be implicated in a series of assassinations targeting the Russian Tsars. In 1860, Russia established its own state bank, which would become one of the most influential financial institutions in Europe by 1914. With vast gold reserves and minimal national debt, Russia's economy thrived, making it the world's breadbasket and a hub of industrial growth. By 1913, Russia produced a significant portion of the world's grains and held more gold reserves than any other country. Industrial production soared, and the nation enjoyed low levels of taxation, no inflation, and high employment. Socially, Russia was a pioneer. It abolished serfdom, expanded education, and introduced advanced labor laws. These measures created a workers' paradise, contrasting sharply with the rest of the industrialized world. However, the Rothschilds, fearing the example Russia set, financed the Bolshevik Revolution in 1917. This led to the fall of the Tsarist regime and the establishment of a Soviet state beholden to international bankers. Prominent revolutionaries, including Maxim Litvinov, were instrumental in funneling Russia's wealth to Western banks. The Soviet Union, under Bolshevik control, became a puppet in the hands of these international financiers. Post-World War II, the establishment of the World Bank and International Monetary Fund at Bretton Woods further solidified the grip of international bankers. The Cold War that followed was much about financial dominance as it was about political ideology. Despite its resistance, the Soviet Union eventually succumbed to the pressures of global finance. In 1991, the Soviet state dissolved, leading to the introduction of free market capitalism and further enriching the power of private banks. The saga of Russia and the Rothschilds is a profound chapter in the history of global finance. It underscores the enduring conflict between state sovereignty and the power of international banking, a battle that continues to shape our world today. In the Roaring '20s, the world was on the brink of monumental change. The stock markets were booming and prosperity seemed boundless. But beneath this veneer of wealth and success, a storm was brewing, a storm that would lead to one of the darkest periods in modern history, the Great Depression. At the heart of this financial maelstrom were the central banks. By the early 20th century, only 18 central banks existed worldwide. Their establishment was driven by powerful financiers like Montagu Norman, the governor of the Bank of England, who believed that these institutions should be independent of government influence. Capital must protect itself in every possible way, both by combination and legislation. In 1922, the Genoa Conference marked a pivotal moment. Heads of state and prominent bankers convened to set up central banks in every country. The aim? To consolidate financial power and control under a central authority, independent of government oversight. The creation of the Bank for International Settlements, or BIS, in 1930 further centralized global financial power. Ostensibly formed to facilitate German reparations after World War I, the BIS quickly shifted its focus to fostering international monetary cooperation. However, its real purpose was far more insidious. The BIS was to be controlled in a feudalist fashion by the central banks of the world acting in concert. In the lead-up to the Great Depression, central banks wielded their immense power to manipulate economies. In 1927, the Federal Reserve, under orders from powerful financiers, began pumping money into the stock market, creating an artificial boom. By 1929, the bubble burst, leading to an unprecedented financial collapse. The stock market crash of October 1929 was just the beginning. The Federal Reserve's sudden contraction of credit devastated the economy. Banks failed, companies went bankrupt, and millions were left unemployed and destitute. The Great Depression had arrived. The human toll was staggering. Over 24,000 banks failed, millions lost their jobs, and countless families were thrown into poverty. An estimated 3 million people died from starvation and related causes. It was a time of unimaginable hardship. Behind the scenes, central banks, particularly the BIS, operated with near total autonomy. They held bi-monthly meetings in secret, influencing global monetary policy without accountability. Their decisions, made in private, shaped the economic realities of nations worldwide. The ultimate aim of the BIS is a single world currency, a one world economic system, and global government. As the Depression deepened, some political leaders began to speak out. Congressman Louis T. McFadden, a vocal critic, accused the Federal Reserve of deliberately engineering the crash to consolidate power and control over the U.S. economy. The Federal Reserve Board and the Federal Reserve banks have cheated the government and the people of the United States out of enough money to pay the national debt. Today, central banks remain powerful players in the global economy. Their influence, forged in the fires of the Great Depression, continues to shape monetary policy and economic conditions worldwide. Clifford Hugh Douglas was an engineer whose keen observations during World War I led to groundbreaking economic insights. While working at the Royal Aircraft Factory in Farnborough, England, he noticed a curious discrepancy. The total cost of goods produced exceeded the total payments made to workers and investors. Douglas embarked on a quest to understand this anomaly. After analyzing data from numerous companies, he concluded that there was a persistent shortfall in consumers' purchasing power relative to the cost of production. Douglas formulated the AB theorem to explain this gap. According to his theorem, the prices of goods are generated at a faster rate than incomes. This means that at any given time, the total prices in an economy surpass the total buying power of consumers. To bridge this gap, Douglas proposed a revolutionary idea, the national dividend. This dividend would be paid to all citizens, giving them additional buying power to absorb the production of goods without causing inflation. Douglas's economic theory, known as social credit, advocated for significant change. He suggested transferring the money creation process from private banks to a state bank, ensuring that money would be created as a public utility rather than as interest-bearing debt. He also introduced the concept of just the price, a mechanism to reduce prices based on technological efficiencies. This way, the benefits of technological advancements would directly improve worker standards of living. After World War I, Douglas dedicated his life to spreading his ideas. He lectured across the globe, from Australia to Japan. Notably, the Social Credit Party in Alberta, Canada, adopted his policies and gained control of the provincial government in 1935. His ideas even influenced the Japanese government in the early 1930s. Despite opposition from international bankers who feared his policies, Douglas remained a vocal critic of central banking systems, famously calling the Bank of England a mental institution. Irving Fisher, another titan of economic thought, was a Yale University professor known for his mathematical approach to economics. His work laid the foundation for modern utility theory and the quantity theory of money. Fisher's insights into interest rates and the value of goods over time were groundbreaking. However, his career faced turbulence due to his support for alternative monetary policies, which clashed with powerful financial interests. One of Fisher's most influential contributions was the Chicago Plan, which he detailed in his book, Dollar Stabilization. The plan proposed that the state should create the nation's money supply, with private banks operating on a full reserve basis. Fisher argued that this system would stabilize the economy, eliminate bank runs, and drastically reduce both government and private debt. Decades later, in 2012, researchers at the International Monetary Fund revisited the Chicago Plan and found that Fisher's predictions were astonishingly accurate. The struggle for financial sovereignty is far from over. As history has shown, the control of money is the control of nations. The fight against central banking's pervasive influence continues, driven by a desire for true economic independence and justice for all. Thank you for joining us on this journey through the history of central banking and its profound impact on our world. If you found this video informative, please like, share, and subscribe for more deep dives into the forces shaping our society. Leave a comment below with your thoughts and what topics you'd like us to cover next. Until next time, stay informed and stay empowered.